Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
How you going, everyone? Thanks for joining us on the podcast today. We're going to get a bit mechanical, a bit technical. So if that doesn't sound like you and you want to always hear about the philosophical stuff, this one might not be for you, but I imagine most property investors will get a lot of value out of this particular podcast. So hang on, tune in, grab a hold of whatever armrest you're sitting on right now, and you're going to get right into the nuts and bolts of depreciation. This is something that's important to all property investors, whether you're new to property or you've been in the game for quite some time. All properties at a point in time will have some sort of appropriate relationship with depreciation. You would have heard, it's probably a couple of years ago now, there was big changes to depreciation, how things would change mainly around second-hand properties, so existing properties, and there's still a lot of certainty in that regards. We haven't really got into it recently, so I've asked in the studio Tuan Duong. He's a QS, which means quantity surveyor, from a company called Duo Tax, and we're going to get right into the top 5 questions that people most ask about depreciation. Tuan, how you going, mate? You well?
Very good, thank you. Thanks for having us on the show today, Phil.
So, a QS, quantity surveyor. Yep. Let's just cover that off first, because a lot of people go, I don't know what that means. What does a QS do?
Sure. So quantity surveyors are construction economists. Effectively, what we do is we price up construction for the purpose of independent advice. So that's typically to provide advice on construction costs for the purposes in one, depreciation to the ATO. So using that as advice to give the, property investor, a little bit of advice on the tax depreciable components. Secondly, on building construction in the council. So council obviously assess values of construction for the purpose of Section 94, which they also call council contribution, which is a tax that people pay when they go to develop a new building. And thirdly, for the banks. So the banks would want independent advice on construction costs when it comes to lending for construction loans. So we provide advice and progress claim payments and whatnot, but that is where we sit amongst that journey.
So when you're a little kid and people are going, I want to be an astronaut, I want to be a fireman, did you go, I want to be a quantity surveyor? How did you end up doing this?
I was actually born and bred into civil engineering. I was prior to this a civil engineer, studied construction management as a degree, and then got into the field of tax depreciation as a property investor myself. Buying an investment property back then for me was one of the things that was most important. And from there, I learned from my accountant that depreciation value schedule adds a lot of value into a property journey, and especially in terms of, negatively gearing a property. So lots of value there. And I thought, you know what, this is great value for any investor and everybody should be taking it up, especially for a brand new townhouse that I bought back in 2012, I believe. Yeah.
So let's get you back in the studio at some point and actually talk about your property investment journey. I think today I just want to pick your brain around depreciation, and it's good that you're coming in because it's quite interesting how you're wired, that you wake up every morning and go, wow, I just love spreadsheets and numbers and working out how much stuff costs. Like you got to be wired a particular way to do that. So I think about it, I go, when I think of depreciation schedules, I'd sort of turn around and walk the other way. I go, I don't want anything to do with that, even though I need to.
That's why we're here, Phil. That's why we're here to take care of all that.
Well, what is it that you really like about doing this?
I guess
I'm not saying that's boring, but
I'm a numbers guy. Yeah. Being a civil engineer, there was a lot of number crunching involved in that experience itself as well. And I guess the crux of it is eventually we know the value of what we do provides, endless amount of value for 40 years on any rental property in Australia. So you buy a rental property that's brand new with a single depreciation schedule. If you're adding, $50, $100 a week to someone's pocket, that does change some lives, and it changes the way people develop their property portfolio. And it gives them a lot of opportunity to then delve into more property. And I guess it's very important, especially for your listeners out there.
Oh, yeah, absolutely. I get how important it is. It's one of these things, though, when people think about property investment, they go, I love property. They go, I just love it. They go, well, why do you love it? And they go, because, I get to do this, that, and the other. And I love buying and negotiating and all this sort of stuff. And that's like the bit that most people talk about when it comes to property. They often don't talk about this stuff, right? Which is doing your end of year accounts, which most people find a pain.
Yep.
And you get your accountant to do it, good accountant to do it. But to your point, this bit around, if you get this depreciation bit right, it can really change or amplify your investment. It even turns some investments from negatively geared to positively geared, or support that journey over time. And I know that I've been one of these people over the years where I've just really neglected the depreciation side of things. And then I'd sort of go, I've got to sort this out, and I'd quickly scramble around it. One of our questions today is around that. But the point is, you got to get this stuff right if you want to be a serious property investor.
Correct. I have to agree with you there. And without a doubt, that's where I started mine. And it was just always been an imminent part of my property investment journey. And finding that $25, $50, and you're right, having a negatively geared property, but turning into a positive cash flow investment property, it can make a massive difference to your lending capacity and whatnot for future property. So it's super critical.
Yeah, I don't think I've met one property investor who hasn't said to me, I invest in property because I want to make money, right? Yeah. You don't invest in property to lose money.
That's it.
Unless you're mad or an idiot. Okay, so we covered all what a QS is. What is depreciation? Let's do some sort of big things before we get into the question. What is depreciation?
So depreciation, as per the ATO's guideline, is that any asset that declines in value over a period of time, and that wear and tear on the asset itself is a deductible component, a part of your income that's assessed for that financial year. So the job of a quantity surveyor is to assess the depreciable asset's value, and then over time apply a depreciation rate for each financial year that's given by the ATO. So the quantity surveyor is ultimately providing the asset value only. The depreciation rates actually come from the tax commissioner itself. So they'll come with various effective lives on each asset, depending on the type of asset, the wear and tear in that asset. For example, carpet would generally, I think, yield about 13 years worth of depreciation, whereas assets like air conditioners only last 7 years. So that's our job, to apply those rates relative to the type of asset.
So that's the QS roles, depreciation being the principle of something going down in value. And if I was going to do a QS course, would the first lesson be what is depreciation, right? That's probably a pretty important question. So it's a concept that every property investor should actually understand.
Certainly so. And obviously the assessment between type of assets that can be depreciated, end of the day is trying to distinguish what assets are depreciable and what aren't. Things like, obviously, excavation is not a depreciable component where you
can't depreciate dirt.
Yeah, correct. And likewise with landscaping. Softscaping cannot be depreciated, but you can depreciate a retaining wall. So it's about identifying what's hardscape, man-made, and what's, natural. So we've got to make an assessment on those things.
So for me to generalize this, every property investor can actually understand this and not get too bogged down in language. A quantity surveyor's job is to apply the rules set by the tax commissioner around the process of depreciation, and you use a depreciation schedule to do that.
Correct. That's correct.
Is that the most simple way possible?
That's the simplest way to put it.
Okay, so the depreciation schedule is something you get, you wave it in your hand, and a quantity surveyor does that for you, and then you give that to your accountant and say, when you do my financials at the end of every year, here's the schedule that you need to apply the year on year, the depreciation of these assets, or how many properties you got.
That's correct.
Okay, cool. All right. Well, I hope that makes sense for everyone. And as you know, if you've been tuning in the Smart Property Investment Show for a while, I try and simplify things. I want to get now, Tuan, into the 5 most asked questions that you get asked all the time from property investors. But before we do that, just a quick break. Back in a moment. Welcome back, everyone. Here with Tuan Duong. We are chatting depreciation, and we're going to get into the 5 most asked questions around depreciation. Question number 1 is, and I'm just going to ask a question and then we'll have a bit of a chat around it. I'll lean on Tuan to give me his insights in this stuff. My property is second hand. Can I still claim depreciation on it?
Great question, Phil. And the most common question of all. Definitely, there are some rules and legislations around what can be claimed, especially in second-hand property. It's the biggest myth, I guess, and people are always unsure, especially going to seeing an accountant. And I guess it's as simple as us working out. There are 2 types of depreciation that are available. They call it Division 40, which is your plant and equipment. The second method or type of asset of depreciation is Division 43, which is your capital work or your building depreciation. Effectively, the building depreciation is allowed at 2.5% per annum. That means we can claim on the building for 40 years, 2.5% over 100. The plant and equipment, though, the allowance on plant and equipment depreciation prior to the 9th of May 2017, when you purchased the property or exchanged on the property and rented that property out, you could always claim depreciation on the plant and equipment, even if it was secondhand. Brand new, no brainer, we can claim depreciation, but it was secondhand, we could always claim depreciation as well, albeit that the asset life had to be reduced because it was not brand new, and the asset value had to be assessed by a quantity surveyor as a secondhand asset. So, a square meter of carpet today might be $75. If we were to assess something that was built in 1994, we might assess it at $35 a square meter. So now what happened was the ATO came up with a new legislation back in 9th of May 2017. Federal budget allowed allowed that they were going to they did scrap depreciation on secondhand plant and equipment effective of that date. That means if you buy a property or exchange on a property, signing the contract after the 9th of May 2017, no longer are you able to claim depreciation on secondhand plant and equipment for residential property owners, whether it's individual or self-managed super fund. Companies are exempt and commercial properties are exempt. So this only applies to residential property investors that are purchased under individual and self-managed.
Well, that leads us to our second question. It's sort of connected in with the first one, so I'll ask it now. It says legislation has changed, which you mentioned.
Yep.
The budget, federal budget in 2017.
Yep.
Is there any reason to still do a depreciation schedule?
So given that if you've purchased a property prior to the 9th of May, certainly 2017, certainly is worthwhile getting a depreciation schedule because it is grandfathered. The Legislation Act is grandfathered, meaning that if you did purchase before that date, you are protected from the new legislation. So it is worthwhile getting a depreciation schedule if your property is secondhand. And if your property is purchased after that date, is it still worth it? Certainly is. If the property is built after the 17th of September 1987, that is the cutoff date for residential properties that are still able to depreciate the capital work component. So the building is only depreciable if it's built after that specific date. So in my experience or my profession is that I advise people to always get a report if it's built after 1987. Generally, we could still find $1,500 to $2,000 as a minimum on a building that's built after that date. So it's always worth getting a quantity survey. We can always do a check on the rental property build date, whether it's through RP data sources that are available to professions, but also the council also has access to this information, which allows us to work out how much depreciation we can claim prior to even doing or engaging us to do the property depreciation schedule.
My knowledge of this is reasonably limited, but I've sort of anecdotally I can chat about it. Now, I remember I'm looking back to May 17 when those changes happened and everyone went, oh no, property investment, it's going to be uneconomical to invest in property anymore. And people got really confused about it, right? And there was a period in the wilderness there where they made these recommendations. No one actually knew how it was going to be implemented, and then it got implemented. Now, by memory, the basis of the argument around scrapping depreciation for existing properties was that people kept double dipping down on the depreciation. So, I would buy a place, I'd depreciate it for a year or two, then I'd sell it to someone else who would depreciate it again. That would start again and again and again and again.
Yep.
So this piece of carpet probably got depreciated, umpteen number of different times, and it really wasn't economical or, actually consistent with the reality of getting this stuff done.
Yep.
Now, and I sort of went, yeah, okay, I sort of get that. And I think at the same time they scrapped all those incentives around sort of travel deductions to go visit your properties and all this sort of stuff. And I went, yeah, that's cool, that's fine. But then I remember chatting to people about this and they said, well, yeah, but normally the plant and equipment is only a much smaller component of the total depreciation versus the depreciation of the house as an asset. And you said after whenever it is in 87 that you can depreciate that asset. So I think the real issue is that if you bought a house that was a year or so old, back in the good old days, there would have been a fair bit of depreciation left on that. But if you bought an existing property, so that would have been a bigger chunk of the rebate you would have gotten your tax around it. But if you were buying a 10-year, 15-year-old property, a lot of that depreciation had happened. So it was really the depreciation of the building was where the real asset was. So the case of legislation has changed, should I continue to do it? It was absolutely, because don't discount the amount of depreciation you still get on the actual building asset.
Yep.
That's pretty much how it worked out, wasn't it?
Correct. And effectively the ATO was the reason for the legislation change was because of the, misuse of the depreciation of secondhand plant and equipment.
Yeah.
In that the consecutive times of the asset being deducted was greater than the cost of the asset itself.
Absolutely.
And there was no allowance for, a secondhand rate of that asset in itself. So that's where the ATO has come up with this legislation. And I guess it's important because people now buying property that are relatively new. And the biggest, I think, concern is that a lot of people are buying rental properties, especially first-time investors, and they're buying it for the purpose of the grant and other, tax incentives that are there, stamp duty and whatnot. They are not, informed about the effect of depreciation, and coming 6 months or 12 months after their first home ownership, They're then finding out that there's no depreciation on plant and equipment when someone said to them that it might be $15,000, $20,000. It's only half that because of the plant and equipment that's no longer there. The brilliant thing about plant and equipment depreciation is it always sort of pulled together a lot of depreciation in early years, because if your assets depreciate over 5 to 10 years on average, you're getting a bulk of the depreciation.
It happens at the front end. That's where it depreciates faster than it goes down, and that's what your schedule normally does. So that was the real people that hurt as part of the change of legislation were those relatively new properties, which normally have a big fat bit of a depreciation in them. And this is where you need to be careful in that a lot of people used to sell properties on the basis of, hey, buy it today because it's new and you get a whole bunch of depreciation, therefore it will be a cash flow positive, right? And this is like red flags for me when I start hearing this stuff. You know, whether a property is negatively geared or positive is an outcome of your own tax affairs or your own capability or borrowing capabilities. So if you see that sort of stuff in marketing collateral, be warned. But some people do get burned on this idea of buying sort of secondhand stuff and not getting depreciation benefits. But as you know, this is something pretty complicated, and I'm very, very generalist in this. So hence the reason why we've got you in, Tuan, to have a chat about this. So let's go to question number 3. But before we do, I'm just going to go a quick break. Back in a moment. Welcome back, everyone. We're getting right into this crazy world of depreciation. I think I made it pretty clear if you hear me mumbling my way through this particular conversation. I'm not very well versed in this, and this is definitely something you need to be leaning on for the experts to get information around. It is important to make sure you get your depreciation done on your properties, irrespective of when you bought it, whether it's new or secondhand, because there is still a lot of depreciation left in the actual building component of the asset, not the plant and equipment, which is what those changes were, which you just touched on. Tuan, the next question we've got here is, I've just knocked down or I'm about to knock down a property. Can I claim any depreciation on that?
Certainly. So we prepared what we call scrapping reports, Phil. And the beauty of the scrapping report is if the property that you're scrapping or demolishing is still depreciable, that means it qualifies for plant and equipment depreciation that's secondhand. That means it has to be purchased before the 9th of May 2017, and you're about to knock it down, say, this year, you're entitled to claim to any depreciation residual that's available effective of the date you knock it down. On top of that, not just the plant and equipment, but also the application, the legislation for Division 43, which is your building works. Now, if your building works was constructed after 1987 of September, you're entitled to claim depreciations, the scrap value on the depreciable value that hasn't been scrapped, so the undeducted construction expenditure. So, your 1990 property might be worth $35,000, $40,000 today. If you do a knockdown today, effectively you can claim that all immediately as a complete deduction, and also all the plant and equipment, which could be, typically I would find on a property that's purchased secondhand a couple of years ago, and it might be, built in the 80s or late 90s or early 90s even, we could find a residual value of maybe $10,000 to $15,000 in a balance. And if you can combine that with construction costs, you're looking at $50,000 as an immediate deduction on the knockdown.
So the plant and equipment plus the actual
building itself.
The building itself. So correct. Like wood and bricks and tiles and whatever else, right?
Everything from the slab up, you'll be able to claim that as a deduction.
So you can deduct the roof trusses, for example, and say,
correct.
What happens if you go and sell that to someone else and get the benefit from it? Does it matter?
There would have to be an adjustment for sure. I guess I imagine there would be some gain from that. So you'd have to do a balancing adjustment with an accountant. But certainly from the standpoint of the construction itself, if you were to do so you knock down some purlins or whatever it might be to do an extension, perhaps that would be some scrap value that you can claim on top of the depreciation on the extension.
Okay, so depreciation on the actual building material you knock down, you depreciate the new building you put on, and we'll get into renos in a moment. But plant equipment being, so if I knock down a building that was built after 1980, so anything before 1987 you can't.
On the building you can't, the plant and equipment.
The plant and equipment,
which is depreciable or deductible if it's purchased before the 9th of May. 2017. Throwing a lot of dates out there.
Okay. This is all pretty. We'll get you to write something on smartpropertyinvestment.com around it. Sounds like this is like a pop quiz, right? To see whether or not you know your stuff. But so plant equipment on a knockdown is like, your dunnies and your kitchens and like an air conditioning system or any of that sort of
Generally,
stuff.
Generally, if the ATO is different, the way I define it is if you turn the building upside down, anything that falls out would generally be your plant and equipment. Okay. Anything that's motorized typically would be plant and equipment. That's range hood ovens, garage motors. So they're typically your plant equipment assets, but the building, anything that's fixed. So when we go into a property, anything that's timber flooring or even carpets, they would be plant and equipment. However, tiling would be a capital work deduction.
Okay. Yeah. And you get this big list. So is every single piece of thing in your house itemised on a ATO taxation ledger somewhere?
Correct.
Like PowerPoints, for example?
Yep, the effective schedule that's prepared by the tax commissioner comes out every year. On that is the effective life of each asset. That does change from time to time. For example, the ATO has recently revised the effective life of carpets. I can't remember if it's reduced from 7 years now to 6 years, but they do revise it from year to year. But that shows only the plant and equipment. So it's ideal for, I guess, businesses and, well, mainly businesses, but there is a component in there that's specially designed for residential property investors. So, that's something that people can refer to, but generally that is the guideline. Not every PowerPoint plasterboard is allowed. Generally, all of that is 2.5% considered as capital works, and that's something for us I identify, I guess, on site.
What's the weirdest thing you've seen on a schedule to be deducted or put a depreciation schedule around?
I would say maybe, I guess, windmill farms, that would be probably one of the most odd sort of things that we do. And there's really nothing that we don't do, petrol stations, you name it.
Any weird sort of like proper weird joints though? Like, it must have been, right?
Probably not.
No.
Some things we probably couldn't even say on a podcast.
I'm thinking about some things that, genuine businesses that people would probably look to do deductions around. But anyway, maybe that could be the insider's guide to deduction or something or other with anyway. Okay, so that's cool. So the fourth question here, I want to take renovation on my property. Is it still worthwhile me doing a depreciation schedule?
For sure. So the guideline, with another date thrown at you there, Phil, is anything that's built or renovated after the 27th of February 1992 is entitled to claim depreciation. So that's the cutoff date for you to renovate a particular, I guess if you wanted to do an extension or an addition to a property, that is a specific cutoff date, and definitely is worthwhile doing that, because with the renovations, obviously is all typically brand new. So you are entitled to claim full depreciation on both the building and the plant and equipment of any renovations. It's also worthwhile knowing that the ATO will only let you claim depreciation on brand new equipment, and that includes purchasing something off a retailer. So you can't actually go purchase something from Gumtree or some secondhand equipment from somewhere else, install it, and claim depreciation. It does have to be correct. It has to have a GST applied to that asset, and that's one of the conditions with the latest legislation. But definitely something else that's worthwhile noting is substantial renovation. So the ATO realised there was an issue with the legislation in that when a property was purchased and effectively substantially renovated, where you've got a property and you've paid a handsome sum for someone else to renovate it, but you couldn't claim the depreciation because it's deemed secondhand. The ATO has come up with the GST Act and saying that if the property is substantially renovated before you bought it, you are entitled to claim depreciation on that substantially renovated property. And that would apply to, I guess, a lot of clients of ours now that are buying properties that for a handsome sum, they're paying some, a premium for these properties, and, they might have a new bathroom, new kitchen, or new flooring, new roofing structure.
So they can claim that?
They could claim that, and also the plant and equipment as well. Okay. So even though they didn't install it themselves physically, because it's deemed as substantially renovated, which is a term in the GST Act, they're now eligible to claim full depreciation as if it was built as a brand new home.
So confusing. So let's just say from a practical point of view, I've got an investment property, and so it doesn't matter whether it's investment property or owner occupied. We're talking about investment here.
Yeah, right? Investment property.
So I go, okay, I'm going to put a new kitchen in. So I spend $20,000 on a new kitchen. That includes, a fridge, a dishwasher, range hood, that sort of stuff.
Cooktop.
Cooktop. Ovens, tapware, sinks, that's all plant and equipment. The actual kitchen cabinetry.
Cabinetry is all fixed, so they'll consider that as Division 43 building work, so 2.5%.
Okay.
So we'll assess that. The sink itself is 2.5%. The tapware is wear and tear assets, so they'll be deemed as plant and equipment. Things like your oven, range hood, whatnot, as you mentioned, are all plant equipment, so they will depreciate at a faster rate than the cabinetry, joinery.
So if I go and do this reno, I need to redo a depreciation schedule.
Effectively, that's what you'll need to do with a renovation of that sort.
Yeah.
Typically, our clients that are doing these properties, these depreciation schedules, they're getting the reports done, and it's not till maybe 1 or 2 years later, for example. We just amend the report to include all the new assets in there, free of cost.
So the stuff that's been depreciating down still depreciates at the same speed, but you just got to make an adjustment to
Correct.
Move
That's
it.
right. That's right. We consider it as a brand new asset, so we'll add that to a report to make that included in that schedule.
Okay. Cool. All right. Last question, and I've I've been this person myself. I haven't done a depreciation report for ages. Can I still do it? So in my case, I've sort of haven't done it for 2 years and then gone, I better hurry up and do that. Or my accountant will go, have you done a depreciation schedule? And I go, I don't know. Work it, I haven't. So it's still worth doing, or can you back claim that time from when you bought it?
Yep.
Timing's going to be a thing, but
Great question. And I would say there's a lot of people in similar situations as yourself, Phil. I've had a client that purchased a property in 1991, never claimed depreciation, and we actually prepared the schedule from 1991. What they did was, there's a couple of things. So before we get to that, is there's some general rules around claiming or back claiming, or any deduction for that matter. You're allowed to amend a tax return as an individual taxpayer for the last 2 years of a notice of assessment. So the date you get your notice of assessment, you're entitled to, which is effectively your tax receipt for doing your tax return, you get 2 years to amend that tax return. Okay. So if you purchased something, you completed your tax return June 2017, you got to June 2019 to amend that tax return. If you do want to go further back than that, you are entitled to. However, it's called raising an objection. You can raise an objection, which is just a form called an objection form that you get from the ATO's website. You can write your reasons as to why you think you're entitled to more deductions further than 2 years. And that's what some of our clients had to do, especially those that are, they have a genuine claim. You've made a genuine mistake in your tax return where you didn't know and you wanted to claim it. It's not always guaranteed, but we've had clients that are quite successful with that, especially ones that are buying in 1991.
Do you need to get a commissioner's ruling on that, or someone else can?
Yeah, the accountant will make an assessment on that, will ultimately provide you that advice. They'll lodge the form on your behalf, or you can lodge it directly yourself, and that will be up to the ATO to decide, or the tax commissioner to decide whether you're entitled to that deduction or missed income, obviously.
To claim back that fast pretty hard. I'd go snooze, you lose. You know, like it's a 91. That's a big check, really.
It's a big deduction, and effectively it's available. And it's really it's at the discretion of the ATO. But 2 years is the allowance for individual taxpayers and 4 years for businesses.
Okay.
Yep.
All right. We covered quite a lot off there. I really enjoyed the chat. You got me back in appreciation. As you can tell, it's like someone go, God. It's pretty confusing. But, thanks for clarifying a lot of that, Tuan.
Welcome.
It's been enlightening once again. So I really appreciate coming. We'll have to get you back and talk about your portfolio at some point.
Sounds good. Thank you, Phil.
Nice one. Thank you very much. Remember to check out smartpropertyinvestment.com.au. If you're not yet subscribing to our daily morning newsletter, so you're the first to know what's happened in property investment right across Australia, smartpropertyinvestment.com.au/subscribe. Any questions at all around depreciation, I'll channel you in the right direction. I'll get them answered for you. You can email the team, editor@smartpropertyinvestment.com.au. Social media, if you're into that, just search Smart Property HQ. Track us down, let us know what's going on. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.